Your budget is a lie, not because you're bad at forecasting, but because your books are a mess. You're building projections on top of numbers that you haven't reconciled in 3 months. Now, that is not budgeting, that is imaginary creativity. Garbage in, garbage out. And the founders who don't fix this end up in board meetings explaining variances that they can't actually explain. Not because they don't know what really happened last quarter. In this video, I'll show you the accounting mistakes that make your budget useless and why I'll clean up later is the most expensive sentence in finance. Hi, I'm Kishore Dasaka and I run a fractional CFO firm for tech startups. I've inherited books so messy that the budgets were off by 40%. And let me show you how to avoid that. Let's start with how budgets actually get built. You pull last quarter's actuals. You make assumptions about the next quarter. You project forward and it looks simple, right? Except here's what is actually happening. Those actuals that you're pulling, half the expenses are in the wrong category. Revenue recognition is inconsistent. Dollar, and there's a $30,000 annual software bill that is not spread monthly. And you haven't reconciled your bank account since November. So when you build a forecast on top of that, you're not projecting reality. You're projecting chaos. I had a client last year who couldn't understand why his budget was always off. Every month, 20 to 30% variance. He thought he was bad at forecasting. Turns out that his accounting was the real problem. Expenses were miscategorized, revenue was recorded when it was actually invoiced and not when it was earned, and accruals were missing entirely. His actuals weren't actual. So his forecast was a fiction story. We spent 2 months cleaning up his books, and in the next quarter, his variance dropped to about 5%. He didn't get better at forecasting. He got better at knowing what actually happened. And that is the foundation that most founders skip. Now, let me show you the specific problem that I constantly see. Mistake number one, expenses in wrong categories. Marketing spend buried under general expenses. Software subscription scattered across 5 different accounts. Contractor payments mixed up with payroll. When your categories are inconsistent, you can't see the trends. You can't compare them month on month. And your budget assumptions are based on numbers that don't really mean anything. I've seen founders think that they're spending $20,000 a month on marketing when the real number is $45,000 because half of that number was hidden in other categories. Mistake number two, revenue recognition timing. Some founders record revenue upon invoicing. Some founders record it when cash hits the bank, and some record it when the contract is signed. If you're not consistent with your accounting policy, your revenue numbers are meaningless. And if you're a SaaS company recognizing annual contracts upfront instead of spreading them over 12 months, then your P&L is lying to you. Mistake number three, missing accruals. That 40,000 annual insurance bill, that $15,000 annual contract, that $15,000 quarterly tax payment, that $25,000 software renewal. If you're not accruing for these monthly, they hit your books all at once. Your January looks great. Your February looks like a disaster. But nothing has actually changed. And when you do budgeting based on this, you build in fake volatility that makes your variance almost impossible to analyze. Mistake, mistake number four, mixing cash and accrual randomly. Some transactions are on cash basis, some on accrual basis. There is no clear system, and this is more common than you think. And it means that your P&L doesn't tie to your bank account, and your budget doesn't tie to your P&L, and nobody knows which one is actually true. Mistake number five is stale reconciliation. Your bank account says one thing, your books say something else, and you haven't figured out the difference since the last quarter. Every unreconciled transaction is a potential error, and every error flows straight into your forecast. These 5 mistakes don't look like budgeting problems. Mistakes don't look like budgeting problems. They look like accounting problems. But they're actually the reason but they're the reason why your budget never real, but they're the reason, but they're the reason why your budget never matches reality. Here's where this really hurts you. The whole point of budget is to compare the plan with the actuals. You set a target, you measure what happened, and then you figure out why it was different. The feedback loop is how you learn. That's how you get better at running a company from a finance point of view. But if your actuals are unreliable, variance analysis is meaningless. If you're 20% over budgeting on engineering, is that a spending problem or a categorization problem? You're 15% under on revenue. Did that did sales underperform or did you record it the wrong month? You just can't tell. So you end up in a board meeting explaining variances that might not even be real. I've watched I've watched founders spend an I've watched founders spend an hour explaining why marketing was over budget, only to discover later that 30,000 of marketing expenses were actually product costs that got miscoded. The variance itself was not real. The explanation was fictional, and everyone wasted time on a problem that really did not exist. Clean books aren't about being buttoned up. They're about being able to trust your own numbers. Here's what I usually hear from founders. They say things like, we'll fix the, we'll fix the books when we raise. We'll clean it up before due diligence. It's not perfect, but it's good enough for now. Now, this is the most expensive mindset in startup finance because accounting debt usually compounds like bank debt. Every month you don't reconcile, the mess gets bigger. And every quarter you let miscategorization slide, the cleanup gets harder. And by the time you actually need to clean the books, a fundraise, an acquisition, an audit, you're looking at a $50,000 cleanup project and about 6 to 8 weeks of hard work. I've seen deals get delayed by months because the books were not ready. I've seen term sheets getting pulled because due diligence uncovered inconsistencies that the founders could not explain. I've seen founders realize mid race that their revenue numbers were wrong and they had to redo their entire tech. The I'll clean up later approach always costs more than fixing it now. Always. So, what do? You need consistent and timely books. Here's the standard that I hold my clients to. Books need to be closed within 15 days of the month end. Not 30, not 30, not 45, 15 days. If you're closing January books in mid-March, your data is too stale for it to be useful. Fast closed means fast decisions. Consistent chart of accounts. Every expense goes in the same category every time. No judgment calls month to month. And if you're not sure where something goes, just pick a category and stick to it. Consistency always beats precision in the long term. Monthly bank reconciliation. Every month, your books and your bank tie up. There should be no unexplained differences. And if there is a gap, you need to find it and you need to fix it. Accruals for large expenses. Any bill that is over $5,000 that you know is coming needs to be spread monthly, be it insurance, annual software, or tax payment. Don't let them surprise your P&L account. AR and AP should always be reconciled. You need to know who owes you money and you also need to know who you owe. And those numbers need to match to your books. That's it. Not perfect, not audit ready, but reliable enough so that your forecast means something. If you can hit these 5 standards, your budget will actually reflect reality. Here's what I tell every founder that I work with. Your forecast is only as good as your actuals. If you don't know what happened last month, you cannot predict what will happen next month. If your books are a mess, your budget is a fiction. The founders who skip accounting hygiene end up with budgets that they can't explain, variances that they can't diagnose, and board meetings that they can't survive. Fix the foundation first. Clean the books, consistent categories, monthly recognition. Then your budgeting becomes a tool, not a guess. If you found this video helpful, share it with another founder who may need it.